Soros' 2007 subprime bet, the $1 billion trade that predicted America's housing crash. Hi my friends, welcome to ZC's Finance channel. This is the 10th episode of ZC's 5-Minute Financial Series. And today, we're telling a story of how George Soros turned a quiet hunch about America's housing market into one of the most profitable trades in history. His 2007 bet against America's subprime mortgage lenders. It's a tale of spotting cracks in a booming market, waiting for the right moment, and walking away with over $1 billion. All while the world was still celebrating the housing bubble high. Let's follow the timeline, step by step, as this financial drama unfolded. The year was 2005, and America's housing market was on fire. For a decade, home prices had soared 300% in some cities. Families were taking out no-document loans, where they didn't even need to prove income, to buy houses they couldn't afford. And banks were handing out subprime mortgages loans to borrowers with bad credit, like candy. Even real estate agents were telling clients, prices will never drop, this is a new normal. But Soros, who'd made his name spotting market flaws in the 1990s, think his 1,992-pound trade, saw something others missed. His team at Quantum Fund started digging into data in early 2005. They tracked subprime mortgage defaults, which slowly crept up from 5% to 7% in 6 months, and noticed banks were packaging these risky loans into mortgage-backed securities, MBS. Complex financial products sold to investors who had no idea the underlying loans were likely to fail. Soros called his top traders into a quiet New York office that summer and said, "This isn't sustainable growth, it's a bubble held together by hope. And bubbles always pop. We just need to wait for the first crack." By late 2006, that crack appeared. A small subprime lender in California, New Century Financial, announced it was losing millions after more borrowers stopped paying their mortgages. The market brushed it off as a one-time problem for a small firm. But Soros knew it was the start of a wave. His traders quietly bought credit default swaps, CDS, a type of financial contract that pays out if a loan defaults, on $15 billion worth of subprime MBS. He didn't stop there. He also shorted the stocks of big subprime lenders, like Countrywide Financial, which had lent billions to high-risk borrowers, and even some banks that held large amounts of MBS. "We're not betting against houses," Soros told his team. "We're betting against greed and bad math." Then came 2007, the year the bubble burst. In February, New Century Financial filed for bankruptcy, and its stock plummeted to near zero. By March, more lenders started collapsing, and investors finally woke up to the risk of MBS. The price of subprime MBS dropped 40% in just 2 months, and Soros's CDS positions started paying out huge sums. But he didn't cash out yet. In June, Countrywide Financial warned it might go bankrupt, and the American Federal Reserve had to hold an emergency meeting to discuss the crisis. That's when Soros decided to start locking in profits. He sold half his CDS positions and covered his short stocks. By August, the numbers were in. Quantum Fund had made over $1 billion from the trade. When a reporter asked him if he felt guilty about profiting from a crisis that would hurt homeowners, Soros said, "I didn't create the bubble. I just saw it, and positioned accordingly to protect the fund's investors." The aftermath? By 2008, the subprime crisis had spread to the entire American financial system, leading to the collapse of Lehman Brothers and a global recession. But Soros had exited most of his positions before the worst hit, saving his fund from the chaos. He later said the trade taught him 2 lessons. First, never trust a market where everyone says this time is different. Second, patience is more valuable than speed, i.e. waiting for the right moment beats rushing into a trade. If you love this story of Soros's 2007 subprime bet and buy, a tale of patience, research, and seeing what others didn't, hit like and subscribe. Next episode, episode 11, we're sticking to George Soros's legendary trades, with a case we've never covered. His 2012 short on EU sovereign debt, focusing on Greek government bonds. We'll walk through how he spotted Greece's unsustainable debt. Its debt-to-GDP ratio was over 150% at the time. How he built his short positions without triggering market panic. And how he locked in profits as Greece's debt crisis escalated. And the EU scrambled to bail the country out. Subscribe now. You won't want to miss this story of Soros navigating the chaos of the EU's debt troubles. And how he turned a crisis in one country into a win for his fund. Thank you.